Welcome back to Talk Tickers. This is our deep dive where we essentially stop pretending that just skimming a press release counts as actual research.
Right.
We try to crack open the market, look at what's actually driving these companies, and, break it down for you. I'm your host, and I'm joined, as always, by the person who actually enjoys reading the fine print in the footnotes.
I mean, enjoy is definitely a strong word for it. I tolerate the footnotes mostly because that's usually where the bodies are buried. But yeah, it's good to be here.
Today's big one. We are looking at a company that's currently attempting, honestly, one of the most bizarre and ambitious pivots I think we've seen in modern retail.
Oh, absolutely. Bizarre is the right word.
We're talking about Beyond Inc. Ticker symbol is BBBY. It's Monday, February 23rd, 2026. The markets are closed. The earnings just came out post-market. And I don't even know if we can call this a retail company anymore.
You really can't. If you tuned into this call expecting, an update on towel inventory or cotton prices, you probably thought you were on the wrong dial-in.
Right.
This wasn't a retail update at all. It was basically a philosophical manifesto. We were watching them try to morph from selling bed sheets into a, what do they call it? A home operating system.
A home operating system.
They're pitching a future where they sell you title insurance, home warranties, mortgages, and eventually, wait for it, a blockchain-based deed to your actual property.
It sounds like an absolute fever dream.
It does.
Let's set the stage for you with the immediate market reaction, because the market is famously efficient. And usually, if a distressed retailer announces they're pivoting to, quote, blockchain and insurance, the stock either goes straight to the moon or straight to zero.
Yeah, there's no middle ground usually.
But right now, it's just flat.
It is remarkably flat. I'm looking at the after-hours board right now. The stock is hovering right around $5.11. That's up about 0.8%.
Less than 1%.
Barely moving.
Which is strange, right? Because looking at the cheat sheet we have here, they actually beat the numbers.
They did. It was a double beat, top and bottom line. But that muted reaction tells you everything you need to know about the current sentiment. The market is completely in a show-me mode.
Yeah.
Investors are looking at this massive, sprawling PowerPoint deck of a strategy and saying, okay, the math on the spreadsheet looks a little better today, but this whole ecosystem story, we need to see it to actually believe it.
It's the complexity discount when you have to explain your business model with a flow chart that looks like a conspiracy theorist's wall. Investors naturally get nervous.
Exactly.
So here is our roadmap for this deep dive. We're going to eat our vegetables first. We have to go through the Q4 2025 headline numbers because they set the floor for everything else.
A hard data.
Right. Then we're going to dissect this three-pillar strategy, which is really the meat of the discussion. We need to talk about these mystery acquisitions involving a massive real estate brokerage network.
That was wild.
Then we get into the sci-fi segment, the LifeChain blockchain project. And finally, we'll wrap up with our This Is Not Financial Advice segment, where we're going to pitch a trade for you that is, frankly, a little unhinged.
I have been looking forward to that trade pitch all day. But yes, let's start with the vegetables.
Okay. Q4 2025. The headline number that the algorithms always trade on is EPS. They came in with a non-GAAP loss of 30 cents. The street was bracing for a loss of 43 cents.
Right.
So they beat expectations by 13 cents.
Which is a very significant beat. Percentage-wise, that's a massive outperform on the bottom line. It tells you immediately that the cost-cutting measures the layoffs, the facility closures, all those efficiency drives, they're actually biting.
They're working.
Yeah, they're spending significantly less money just to keep the lights on.
And on the top line, revenue came in at $273.3 million. Consensus was sitting at roughly $263 million. So another beat. A solid double beat. But, and here is where the bears are going to start growling, that revenue number is down. It's significantly down from last year.
It is. It's down 9.8% year over year, almost double digits.
Right.
Now, the company's going to tell you, hey, we exited Canada, so that completely skews the numbers.
Sure.
And fair enough, if you strip out the Canada exit, the revenue is only down about 6.4%. But it is still down. The company as a whole is shrinking.
And this is the part I really want to dig into with you, because usually when a growth company or even a turnaround story posts shrinking revenue, the stock just gets absolutely hammered. Wall Street is completely addicted to growth.
If you aren't growing, you're dying.
Right. But management didn't apologize for this drop on the call. They seemed almost proud of it.
They were proud of it because it was highly intentional. This brings us to their whole concept of margin integrity. It sounds like standard corporate buzzword bingo, but it's actually a very disciplined, a very painful strategy to execute.
Break that down for me. How do you intentionally lose roughly 10% of your revenue and call that a massive win?
Think about it like this. In the old days, or even at a typical retailer right now like a Wayfair, the goal is top line at all costs. Say you sell a toaster for $50.
Okay.
It costs you $30 to buy it from the manufacturer. It costs you another $15 in Google Ads to acquire the customer. And then it costs you $8 to ship the thing.
Let me do the math. 30 plus 15 plus 8, that's $53.
Huh.
But you only sold it for $50.
Exactly. You lost $3 on that transaction.
You're paying people to take the toaster.
Basically, yeah. But on the earnings call, you get to say, hey, we generated $50 in revenue, Wall Street cheers, the stock goes up, and you just keep burning cash until you eventually go bankrupt.
Wow.
What Beyond Inc. did this quarter was they went through their entire vendor list and their entire SKU count with an absolute machete. They looked at that specific toaster and said, this has a negative contribution margin. We are physically losing money every single time someone buys this.
So they just fired the toaster.
They fired the toaster.
Yeah.
They fired the vendor who supplied it. They effectively fired the customer who only comes to the site to buy that toaster.
That's ruthless.
They consciously chose to shrink the overall revenue base to ensure that every single dollar coming in actually contributes to profit. That is why they call it margin integrity. They are sacrificing the vanity metric, which is revenue, for the sanity metric, which is profit.
It makes sense, but that's a terrifying transition to manage because there has to be a floor, right? You can shrink your way to profitability, sure, but you can also just shrink your way into total irrelevance. If you fire too many products, nobody comes to the website anymore.
That is the ultimate risk. But if you look at the actual profitability metrics from this quarter, the strategy is currently working. Look at the gross margin.
Okay.
It jumped to 24.6%. That is up 160 basis points year over year. You do not get that kind of margin expansion by accident. That confirms they successfully cut the junk that was dragging the average down.
And if we look at the net loss, it narrowed significantly. They lost $21 million this quarter, a year ago. They lit $81 million on fire.
Right.
That is a $60 million improvement in 1 year.
And the adjusted EBITDA loss, which is really the proxy for asking if the daily operations are actually working, that shrank to just $4 million. A year ago was a $27 million loss. They're literally knocking on the door of break even.
The stat that really stood out to me was the cash flow. Operating cash flow usage improved by $118 million year over year.
That is the we are not going to die statistic.
Yeah.
When you are a distressed retailer, cash is oxygen. Improving your cash flow by $118 million means they have officially stopped the arterial bleeding. They aren't totally healthy yet, but they aren't bleeding out on the operating table either.
Okay, so the patient is stable. The bleeding has stopped. They've cut the bad vendors out. Now we really need to pivot to the strategy they laid out. Marcus Lemonis, the CEO, spent a ton of time on this specific distinction between being an aggregator versus a consolidator.
Yes.
To me, it felt like he was really trying to distance himself from the traditional private equity playbook. What is the actual practical difference here for you and me looking at this?
It's a vital distinction because it dictates exactly how they plan to spend their capital. A consolidator is just playing a scale game. Think of it like Pac-Man.
Okay.
You are a grocery store chain. You go out and buy another grocery store chain.
Yeah.
Why? So you can fire their entire HR department, use your trucks to move their goods, and basically bully the milk supplier into giving you a lower price because now you're buying twice as much milk.
Yeah.
You are doing the exact same thing, just bigger.
Efficiencies of scale, the classic Walmart model.
Exactly. An aggregator, on the other hand, isn't trying to get bigger at just one thing. They are trying to own the customer's entire life cycle. Think of it like building a Swiss Army knife. A consolidator just takes two identical knives together. An aggregator adds a corkscrew, a pair of scissors, and a toothpick. They want to cross-sell entirely different services to the same person.
So instead of buying another retailer to sell more towels and sheets, they want to buy companies that sell the other things a homeowner needs.
Correct. The core thesis is this. We already paid the customer acquisition cost to get this person to our website to buy a rug. Why are we letting them leave to go to Geico for their home insurance? Why are we letting them leave to go to a bank for a mortgage? Why are we letting them hire a random contractor on Yelp to install their floors? They want to aggregate that entire share of wallet.
Which naturally leads us to the three-pillar ecosystem they presented. This was really the core of the whole call. Let's walk through these because this is the exact blueprint for their next 5 years. Pillar 1 is the boring one, right? Omni-channel retail.
It's the boring one, but it's the absolute foundation. This includes Bed Bath & Beyond, Overstock, Zulily, and very soon, the acquisition of Kirkland's. Altogether, this creates a roughly $1.5 billion to $2 billion annualized revenue base.
But retail is a terrible business. The margins are incredibly thin. We literally just celebrated the fact they hit 24% gross margins.
Retail is a terrible business for profit, yes.
Yeah.
But it is an amazing business for data. This pillar is just the customer acquisition engine.
Okay.
Nobody wakes up in Google's home ecosystem. They Google cheap sheets. Pillar 1 is what gets them in the front door. It gets their email address, their physical home address, and their credit card info on file. It earns the right to talk to them again.
So pillar 1 is just the bait.
Yes.
Which means pillar 2 has to be the hook.
Pillar 2 is the protection, advocacy, and finance pillar. This is where the actual real money is. We are talking about insurance, home warranties, mortgages, home equity lines of credit.
And the margins here are, well, they're completely different.
Dramatically different. Management, flat out stated, they expect margins in Pillar 2 to be greater than 50%. Compare that to the 24% they scrape by within retail.
Okay, hold on. Let's stop there. 50% margins sound like software margins. They don't sound like finance. Traditional banks don't even make 50% margins usually. How on earth are they claiming that number?
Because they aren't actually a bank. And this is the most critical thing for you to understand about the risk profile here. Beyond Inc. is using an origination and distribution model.
Walk me through that. If I go get a mortgage through Beyond, aren't they the ones lending me the money?
No. They are just finding you. They are processing your initial application, and then they are immediately handing that loan off to a partner bank or selling it directly into the market. They are strictly acting as the broker.
So if I lose my job and stop paying my mortgage...
Beyond Inc. doesn't care. Well, I mean, they care about their overall brand reputation, but they do not lose a single dime. They already collected their fat origination fee on day one. It's the exact same model with the insurance. If they sell you a home warranty and your dishwasher violently explodes, Beyond doesn't pay for the repair out of pocket. The third-party warranty provider they partnered with pays for it. Beyond just took a commission for making the sale happen.
So it's pure fee income. There is no balance sheet risk, no massive underwriting reserves they have to hold.
Exactly. That is how you get to 50% margins. You are monetizing the customer relationship, not taking on the actual risk. It's a brilliantly capital-light model. If, and this is a massive if, you can actually get people to trust you enough to buy major financial products from a company they know for selling bed sheets.
That is the multi-billion-dollar question. Which brings us to pillar 3, home services. We're talking flooring, cabinetry, renovation.
This is the physical execution side of the business. Margins here are projected around 40%. The key differentiator they hammered on is the labor. Marcus made a really specific point about this. He said, most people can buy a towel and figure out how to use it. Most people absolutely cannot install their own kitchen cabinets.
I certainly can. I've tried some DIY stuff and it did not end well.
Exactly. And because you can't do it yourself, you are entirely at the mercy of the local contractor market, which is notoriously fragmented and frustrating. Beyond wants to control that actual labor network. They want to be able to say to you, buy the cabinets directly from us, and we absolutely guarantee the guy who shows up to install them isn't going to rip you off or disappear halfway through the job.
So it all connects back together. If I'm doing a major renovation, which is pillar 3, I probably need financing for it, which is pillar 2. And I definitely need to buy new stuff to put in the newly renovated room, which is pillar 1.
It's complete flywheel.
Yep.
But getting a flywheel that massive to start spinning from a dead stop is incredibly hard. And that is exactly why the wildcard announcement on this call was so shocking to me. They aren't just trying to build this entire ecosystem organically from scratch. They're aggressively buying their way in.
Right.
They announced they are currently pursuing the acquisition of a, quote, scaled residential brokerage network.
This part completely stopped me in my tracks. A distressed e-commerce retailer buying a real estate brokerage. And they said it wasn't a small one either. They literally said targeting thousands to tens of thousands of agents.
Think about the natural customer journey for a second. When do you spend the absolute most money on your home?
The day I buy it.
Exactly. And who is the ultimate gatekeeper to that massive transaction? The real estate agent. The agent is the ultimate local influencer. If you're buying a house, you generally trust your agent. You literally ask them, hey, who should I use for my home insurance? Who should I call for the inspection? Who handles the title work around here?
So Beyond wants to just own the army of agents.
Yes. They want to turn 10,000 real estate agents into the ground-level sales force for the entire Beyond ecosystem. Imagine this scenario. You sit down to sign the papers for your new house. Your agent, who technically works for a Beyond-owned brokerage, says, hey, congrats on the house. By the way, I've already set you up with a competitive quote for Beyond Home Insurance. Also, here is a 20% off coupon for all your new furniture at Bed Bath & Beyond. Oh, and here's a pre-approved offer for a home improvement loan in case you want to redo that ugly kitchen.
It sounds incredibly synergistic on a whiteboard. But I have to play the skeptic for a minute here. Real estate agents are independent contractors. They are notoriously impossible to manage from a corporate top-down level. It's literally like herding cats. You can't just order a top-producing real estate agent to push a specific home warranty. If the product sucks, they simply won't sell it because it ruins their personal relationship with the client, which is their real livelihood.
You are 100% correct. That is the massive execution risk hanging over this whole thing. You absolutely cannot force them. You have to financially incentivize them.
Right.
Levinas believes that because Beyond owns the whole vertical stack, they can offer the agent a cut of the insurance policy, a cut of the warranty sale, a cut of the furniture sale. He fundamentally thinks he can make these agents significantly richer than any traditional brokerage possibly can.
He called it the day two synergy, right? The idea that the very moment they officially buy the brokerage, they plug all these high margin products in and revenue just jumps immediately.
It's an incredibly aggressive timeline, and it directly pairs with the other major financial announcement they dropped, the credit union.
Yes, the homeowners credit union. This was fascinating. Why a credit union specifically? Why wouldn't they just partner with a regular bank?
It all comes down to the interest rate spread. Retail banks think your standard Chase or Wells Fargo. They have public shareholders. They legally need to make a solid profit. So if the Fed rate is sitting at 5%, they might pay you 4% on your savings account and charge you 7% on your mortgage. They keep that fat middle section.
Right. The spread is their profit.
But credit unions are member-owned nonprofits. They literally don't need that massive profit margin. So technically, a credit union can afford to pay you 4.8% on your savings and only charge you 6.5% on a mortgage. They can run a much, much leaner operation.
So the appeal to the regular consumer is essentially, join our ecosystem and we will literally give you better rates on everything than the big banks because we don't even need to make money on the interest.
Exactly. They plan to make all their money on the transaction fees, the warranty commissions, and the retail sales on the back end. The banking side is just the sticky glue that keeps you locked into their ecosystem. Once you have your primary mortgage and your daily checking account tied up with them, you aren't going to casually switch over to Wayfair to buy a rug.
Okay, I see the vision for the ecosystem. It's wildly ambitious, but I do get the internal logic. Now, we have to transition to the part of the call that legitimately made me check if I was hallucinating.
There we go.
The home operating system and the whole blockchain discussion.
Life chain.
Life chain. Look, I'll be honest. Every single time a company that is currently struggling mentions the word blockchain on an earnings call, my scam detector goes absolutely crazy. It usually feels like a desperate attempt to just get the crypto bros to buy the stock and pump it. Is this just that? Or is there actually a real use case here?
I completely share your natural skepticism. Usually when a guy selling towels says blockchain, you should run for the hills. But in this one specific case, specifically for residential real estate, the underlying logic is actually pretty sound.
Okay, defend it. Make it make sense to me.
Okay, think about the current state of data for the home you live in right now. It is an absolute disaster.
That's true.
Your physical deed is a piece of paper sitting in a basement at the county clerk's office. Your property survey is a random PDF lost in your email somewhere. Your renovation history is literally a shoebox of faded Home Depot receipts that you probably lost 3 years ago. Your insurance claims history is locked away in a proprietary server over at State Farm.
It's completely fragmented.
It's way worse than just fragmented. It's fragile. Levinas used the example of the Palisades fire on the call. If a house burns to the ground, all the physical records inside are just gone. If the county courthouse floods during a hurricane, the local title records are damaged or destroyed. It's an archaic, paper-based system.
So the pitch they're making is essentially a Carfax for homes.
Exactly. Think about how much tremendous value Carfax created for the auto industry. You wouldn't ever buy a used car today without knowing if it had been in a major crash. LifeChain is trying to be the immutable digital ledger for the actual home asset itself. They want to put the title, the deed, the survey, the city permit history for any renovations, and the entire insurance claims history all on chain.
That sounds great for organization, but how does that actually make them money? It sounds more like a public utility project.
It lowers risk. And in the world of finance, lower risk equals hard money. If I can definitively prove via a mathematically verified blockchain record that my roof was replaced in 2024 by a fully licensed contractor and that I've never once had a water leak claim, I am objectively a lower risk to an insurance company.
Makes sense.
So my premium should be lower. I am a lower risk to a mortgage lender. My rate should be better.
So the physical home actually becomes more valuable because the data attached to it is clean and verified.
Correct. And if Beyond Inc. owns the underlying platform that validates all that data, they become the ultimate gatekeeper. Every single time a house is sold, every time a new policy is written, they just clip a ticket.
Wait, if the record is perfect, that disintermediates the entire title insurance industry.
It completely obliterates it.
Yeah.
Title insurance really only exists because our current records are messy and hard to track. If the record is absolutely perfect on a blockchain, you simply do not need title insurance anymore. That is a multi-billion-dollar legacy industry that LifeChain is directly targeting.
Okay, that is a massive moonshot. They said development is happening in 2026 with a launch targeted for 2027. But let's bring it back to reality, the next 6 months.
Yeah, let's look at the near term.
We have the Kirkland's acquisition closing right around April 1st. What does the immediate future actually look like for their financials?
Ideally. It looks pretty messy. They were very upfront and honest about this on the call. Integrating an entirely new company is extremely expensive. They expect hard integration costs to hit the books hard in Q2. They have to merge IT systems, maybe close down some redundant warehouses.
So the actual earnings might look pretty ugly in Q2?
They very well might. They said it takes 90 to 120 days to actually start seeing the financial benefits. So the real synergies won't really kick in until Q3 or Q4. And they dropped a very specific little warning about AOV, which is average order value. They think it's actually going to drop.
Which makes intuitive sense, right? Overstock historically sells big, heavy patio sets and couches. Kirkland's mostly sells smaller things like candles and throw pillows.
Exactly. When you blend that inventory together, the average ticket size naturally goes down. But management is aggressively spinning this as a positive. They actually want a lower AOV if it means much higher frequency.
Because you don't log on to buy a massive patio set every single month.
Right. You buy a new couch maybe once every 7 years, but you buy candles or fresh towels or seasonal fall decor maybe 4 times a year. They want that constant transaction frequency because every single time you transact, it's another touch point. It's another chance for them to pitch you on the co-branded credit card, the extended warranty, or the home insurance.
It's the Trojan horse candle.
It's a Trojan horse candle. I really like that.
So looking at the actual financial outlook for 2026, they are guiding for low to mid single-digit revenue growth in the e-commerce segment. It's not exactly explosive growth.
No, it's very modest. But the profitability guidance is the real headline here. They expect EBITDA to improve by at least 30% year over year in Q1 alone. And here is the big stretch goal they casually threw out there. They genuinely want to be break even by Q3 and fully profitable by Q4 of 2026.
Profitable by the end of this year. That is a huge light at the end of the tunnel for a company that was burning cash not long ago.
And importantly, they clarified, and I absolutely loved this detail, that this entire financial plan assumes absolutely no housing market recovery.
Oh, so they aren't just betting on the Fed to save them.
They aren't betting on mortgage rates magically dropping back to 3%. If the housing market does suddenly boom, great, that's just pure upside gravy for them. But they are strictly building a business model designed to work and be profitable right now in this exact stagnant high-rate environment. That is incredibly smart risk management.
So bringing this all back to the stock price, why is the reaction so completely muted? Why isn't the street throwing a massive parade for this double beat and this grand ecosystem vision?
Because talk on an earnings call is cheap. Execution in the real world is incredibly expensive. I guess this is a show me story. You are essentially asking institutional investors to believe that a management team, which is still actively in the middle of fixing a very broken retail business, somehow has the operational bandwidth to simultaneously do four massive things. They have to A, successfully integrate Kirkland's, B, buy and integrate a massive brokerage network, C, launch a brand new credit union, and D, build a proprietary blockchain protocol from scratch.
That is just an insane amount of operational complexity to take on all at once.
It really is. And on top of all that, they have these mystery acquisitions floating out there. Lemon has teased 3 massive transformative deals, one for each pillar, but he couldn't actually name any of the targets yet.
Oh, this leads to the weenie quote. We have to talk about the weenie quote.
God, yes. He literally said on the call, quote, "The weenie is not hidden," meaning he wants to be completely transparent with investors. But practically speaking, until those specific deals are signed in ink, the weenie is very much hidden.
Yeah, we can't see it.
The market absolutely hates uncertainty. Investors are rightfully asking, how are you paying for these massive brokerages? Are you going to dilute our shares? Are you taking on toxic debt? Until those very basic questions are answered, the stock is just going to be stuck in the mud.
And let's not forget the tech stack audit they mentioned. They officially hired Alvarez and Marsal to come in and audit their entire technology infrastructure. You do not hire an aggressive restructuring firm like A&M to look at your tech unless your tech is an absolute mess.
Exactly. They are trying to build a futuristic spaceship, but they are currently driving a 1998 Honda Civic. They literally have to rebuild the entire engine while driving down the highway at 80 miles an hour. That completely terrifies the institutional money.
It's a total high-wire act. But honestly, that is exactly what makes it so interesting to follow. And that brings us perfectly to the part of the show where we stop being serious analysts and start being complete degens.
My absolute favorite part.
This is not financial advice. Seriously, I cannot stress this enough. Do not actually do this. We are literally just two people talking into microphones. If you trade your hard-earned money based on this segment, you completely deserve what happens to your portfolio.
You really do.
But if we were going to pitch a highly volatile, high-risk, asymmetric trade based entirely on the data points from this call, what is it?
I am officially calling this trade the life chain leveraged long.
All right, paint the picture for us. How does this work?
Here is the core thesis. You completely ignore the retail business. Treat the towels, the sheets, the Trojan horse candles as a zero. You view the underlying equity in BBBY purely as a dirt cheap call option on the future data layer of the U.S. housing market.
Okay, I'm tracking.
Right now, BBBY trades on the market like a distressed legacy retailer, maybe 0.3 or 0.4 times their sales. It is dirt cheap. If this crazy ecosystem actually works, if they successfully launch LifeChain and they integrate that brokerage network, they fundamentally stop being a retailer. The market will have to reprice them as a fintech and data company.
And fintech companies trade at completely different multiples.
5 times, 10 times, maybe even 15 times sales.
Right.
The multiple expansion alone on that re-rating makes it a 20-bagger. So the pure play is you go heavily long on BBBY. But you obviously have to hedge the macro execution risk, so you pair that long with a very specific short position.
What are we shorting to hedge this?
We are aggressively shorting the dumb pipes and the dinosaurs.
Yeah.
You short Wayfair. Wayfair is just shipping heavy furniture across the country. They have zero ecosystem, absolutely no data play, just massive shipping logistics costs. And this is the truly spicy part of the trade. You short a traditional title insurance company, like FNF, Fidelity National Financial.
Oh, wow. You are literally betting on their total extinction.
Exactly.
Yeah.
You are directly betting that the home operating system and LifeChain make traditional paper-based title insurance completely obsolete. If Lominus somehow pulls this off, BBBY goes to $100 a share, and FNF tanks because their core product is dead. If he completely fails, well, BBBY probably goes to zero. But the upside is beautifully asymmetric. You're risking 1 unit of capital to potentially make 20.
The LifeChain leverage long. It is absolutely terrifying. I love it.
It's exactly the kind of trade that either buys you a yacht or gets you completely fired from your fund. There is absolutely no middle ground.
It's the only way to live, really. All right, let's wrap this deep dive up. Give us a quick recap for you out there who maybe zoned out during the deep dive into contribution margins.
Summary time. They delivered a very solid double beat on the headline numbers. The aggressive cash burn is mostly fixed. The patient is stable on the table. And the core strategy has officially shifted from just being a retailer to being a comprehensive home ecosystem.
Management is betting the entire farm on their ability to cross-sell high-margin finance and insurance products to low-margin retail customers.
2026 is strictly the build year. It's going to be incredibly messy, very noisy, and highly expensive. 2027 is the projected payoff year.
We will be watching every single quarter. The weenie might be completely hidden for now, but we'll definitely be here to analyze it when they finally reveal it. Thanks for taking this deep dive with us on Talk Tickers. We'll see you next time.
See you then.